Coming to valuations, I just wanted to first give you a chart of how the number of $1 billion, $5 billion, $10 billion companies have moved. You can see we reached a peak in 2007. They were almost close to about 300 companies with market cap more than $1 billion. Today this number has come down to more like 179. But interestingly, if you look at the late 2000, the late 90s, you can see that we had about 26 companies with market cap more than $1 billion. Out of this, we have seen this number increasing. So 125 companies have been created between 2010 and 2011. And if you look at it, there were a number of companies which did not even exist, before 2000. They actually became $1 billion market companies. So this is something that excites a lot of foreign investors, saying that India has got potential. There can be companies which can grow very big in terms of market cap. But this is like what we call as a bottom-up, India story. Top-down, India needs to do, far better. So total FI money, like I mentioned, mark-to-market in equities is now in the region of $225 billion. And this $225 billion at one point of time used to be in the order of around $275 billion at the peak of the market in 2007, 2008. So even now we have not reached that number from foreign institutional investors. As far as valuations are concerned, the Indian market is normally trades between 10 times and 15 times forward. We are now close to the upper end of the normalized trading band. There have been times where we have pierced this band, and these are all euphoric markets. So it's not that the Indian market is extremely cheap, but it's not even expensive. And that's a reason that people need some kind of a correction to see serious money coming in. Having said that, our view is that these 10 times forward multiples are normally tested only in the case of a global crisis. You have a Lehman crisis, you will test 10 times. If there's no global crisis, you normally find that India gets supported about 11, 12 times. So now we are little about 13 times, 13.5 times. So not really, like I said, over the top in terms of valuations, but not very cheap either. At these levels, it's a no-brainer, to buy the market. You just have to assume that you will get good returns, because whenever the market's at 10 times, you'll always get negative news. So, but that's a time to really invest in. And we use this chart for actually timing, entry points into the market. There are a number of charts I won't run you through unless, you have any specific questions. But by and large, you'll see whether it's a P valuation or an EV to EBITDA valuation or a P by B valuation, price to book valuation. India is clearly, now almost close to what it's was historically, trading at. So this number also like pre that number, because analysts will take time to adjust it in their business model. But more important to know, if you look at the Nifty, it is trading at about 13.3 times forward. So you can assume that this, if you look at the earnings growth for next year, projected is about 10%. So if you knock off 2%, it will be somewhere like 8%. My sense is that this number would be revised upwards to around 12 to 13%. So you can look at this number being the real number for next year. Coming to India vis-a-vis the globe, India is trading at about 15 times 2014, about 15 times. This is on calendar years, and you can see that the emerging markets are about 13 times and 10 times. So if you look at 14, it appears to be a bigger premium, but clearly on 13, we are seeing that India has got a small premium over the emerging markets. So it's not that we are at a discount, but the premium used to be very large historically, and that has actually compressed. So to that extent, even though we are a little more expensive, we were far more expensive in the earlier years. Coming to the risk to the India story, I spoke about the current account deficit. So anything that has an impact on our balance of payment is a risk to India. Now, in the US, as you're all aware, they are dealing with these fiscal cliff issues. There's something called sequestration, which is they're looking at curtailing their expenditure to meet their fiscal targets. So you'll get some announcements on this shortly. In my opinion, this will have an impact on US growth. Most of the economists who track US seem to indicate that there'll be at least a 50 basis points that would come only on the back of these expenditure cuts. Eurozone issues continue. You are already aware of what's happening to Italy elections. It's always creating an issue. We are not out of the Eurozone problem. So just because things are quiet doesn't mean that things are settled. We don't want to relapse, so all the agencies, regulators, bankers, everything are working towards making sure there's no global crisis. So global crisis is not our base case estimate. Oil prices is clearly a risk. A $1 increase in oil prices has an impact of around $700 to $800 million on our current account deficit. So that is something which we can't control. So tomorrow, if that goes out of hand, then another problem to the current account deficit. As far as local issues are concerned, we are getting into an election year. So we'll have to see, what they do in terms of politics going forward. 2014 can create some amount of uncertainty. A lot of corporates don't want to invest in advance of what the new government's policy could be. So that could create some uncertainty. We have fiscal deficit, current account deficit, and the governance deficit. Fiscal deficit, as we already discussed today, current account deficit is something, which is a challenge even today. As far as the big constraints for our growth, the issues are connected with land. Land acquisition is not easy. They have a bill, but even post that bill, it is going to be a challenge. And land acquisition will be costlier, so cost of manufacturing and production will increase. And also, availability of, fuel, which is coal, is a big issue. Rising CAD and high gold imports I've already spoken about. So that's broadly, our view on markets. Overall, more modest, expectation for this calendar year. When we started the calendar year, we said that India will report about a 15%, return on an INR basis, rupee basis, in terms of the markets. Last year was a big surprise. Despite all the concerns that people had, the markets did far better, and we received a lot of money. Normally, we find that big money is made in the early stages of the economic recovery cycle, because once the cycle is through, then the story is, largely, known. So the good time is to invest when things are not very good. And that's the reason we believe that the next few years, starting from this year, will see a gradual improvement in the equity markets. If the last 5 to 6 years has not been very good for Indian equities, my view is that the next, 4 to 5 years will be very good for Indian equities. It's also a function of what's happening to other asset classes. The bond markets still have some amount of steam left because monetary policy will be easy. But gold clearly, is showing signs of weakness right now. Physical real estate and number of markets seem to have been peaked. So you will see some reallocation of that money, into the equity markets. So I'm pretty positive in terms of, directionally, you will see money returning into the equity markets and, benefiting from this economic cycle.